Great. Well, welcome everyone. I'm David Weinstein. I'm the director of the Center on Japanese Economy and Business, also known as CJEB, and the Carlos Shoup Professor of the Japanese Economy at Columbia University. We're all delighted to have you here for today's lecture on unconventional monetary policy with the former governor of the Bank of Japan, Haruhiko Kuroda. I'm also joined today by my colleague, Takatoshi Ito, who is a professor at the School of International and Public Affairs at Columbia University and the director of the program on public pension and sovereign funds at CJEB. And he's going to serve as the moderator for today's event. Before turning it over to our esteemed speaker, I just want to introduce the center briefly. CJEB was established in 1986 by Professor Hugh Patrick, who is sitting in the front row, who is a good friend and amazing in terms of building up Japanese economic and business studies in the United States. And founding the center was one of his major accomplishments. And as the new director of CJEB, I am delighted to continue in our mission to promote knowledge and understanding of the Japanese economy and business systems in an international context. I'm really honored to have this opportunity to introduce our speaker, former Governor Kuroda, who led the Bank of Japan from March of 2013 to April of this year. He's achieved the longest tenure as governor since the BOJ's establishment in 1882. He's had an illustrious career in the public and private sector, including serving as president of the Asian Development Bank, special advisor to the cabinet of former Prime Minister Junichiro Koizumi, and vice minister of finance for international affairs. And also, last but not least, was a professor at Hitotsubashi University, which is one of the leading universities in Japan in economics. I first met Governor Kuroda 12 years ago when he was, not 12 years ago, it was 22 years ago when he was then Vice Minister for International Affairs at the Ministry of Finance. And he came to give a talk at one of the conferences that I organize in Japan, the NBR Japan Project meeting in Tokyo. In what was at the time, so remember this was around the year 2000, he delivered what was a very controversial speech to a group of economists. And then at that time, Vice Minister Kuroda, quite frankly and clearly, laid out his vision for the type of monetary policy that he thought would end deflation and restore Japan to economic growth. In remarks at that meeting about 22 years ago, which would later prove prescient, he said that while economists, and I'm quoting here, have argued that the Bank of Japan can more aggressively buy Japanese government bonds, the BOJ contends that monetary policy is unable to stop price deflation. What should be done in the current Japanese situation? Rethinking of policies may be called for. First, the BOJ may adopt more non-traditional measures, including the accelerated purchases of long-term government bonds and/or inflation targeting. It's really remarkable that Governor Kuroda, 20-some years ago, saw things so right and so early. And even more impressive was his courage to say these things publicly. However, his clear thinking and frankness are two of Governor Kuroda's defining characteristics. Governor Kuroda has now had 10 years to implement the policies he advocated, and the results have been truly striking. Japanese core inflation is just over 3% per year at this point. just above the target that he was aiming for. And thus, Governor Kuroda has succeeded in ending deflation and also preventing the high inflation rates that we've seen in the West. While no one would say that no challenges remain, few would disagree that his policies have dramatically changed Japanese monetary policy, and Mr. Kuroda has become widely recognized as an innovative leader in monetary policy. He's known for implementing a vast number of unconventional policies on quantitative and qualitative easing, negative interest rates, yield curve control, and inflation overshooting commitments, to name a few. The BOJ's policies under Mr. Kuroda have transformed not only Japan, but global central banking. I'm also very proud to say that he's been a close friend of CJEB for many years. I've cherished the many meetings that we've had in Tokyo and at Columbia over the years, and we are excited to welcome him back to Columbia's campus and to the center. This is only, he just stepped down as governor just 10 days ago, so I think it's just really wonderful that we're able to have him here and address our students, faculty, and members of the New York community. So I'm really looking forward to hearing his personal views on how various unconventional monetary policies have been implemented by the Bank of Japan and the relationship between monetary policy in Japan and in other countries. I also just want to take a moment to thank our corporate and individual sponsors who are listed in the booklet that you received for their generous donations. These gifts are crucial for us to be able to sponsor events like the one today. So thank you very much. So without any further ado, I want to turn the floor over to Governor Kuroda. Please come to the podium or speak however you want.
Really, thank you very much indeed for your kind word, Professor Weinstein. Today, I would like to talk about unconventional monetary policies pursued by the Bank of Japan, as well as FRB and ECB. So, unconventional monetary policies have been employed by many central banks, particularly after the global financial crisis, or GFC. The Bank of Japan may be unique in the sense that it started quantitative easing, or QE, in 2001, much earlier than the GFC, and introduced a negative interest rate policy and yield curve control in 2016. This talk will survey how various unconventional monetary policies were utilized by the Bank of Japan in comparison with other central banks. The Bank of Japan introduced QE in March 2001. Why? Because the zero interest rate policy had not improved the economic situation much, and deflation persisted since 1998. Faced with the zero lower bound, the introduction of QE was almost inevitable. Subsequently, QE was expanded step by step in 2003 to 6, but ended in 2006 as economic conditions have improved, higher growth rate and positive interest rate. However, the Japanese economy suffered a spillover from the global financial crisis that started in the United States in 2008. The Bank of Japan restarted asset purchases in 2009, which included long-term JGBs, as well as CPs, corporate bonds, and ETFs. But deflation continued with high unemployment and low growth. Actually, the so-called deflationary period of 1998 through 2012, inflation rate on average was minus 0.3%, relatively mild, but quite persistent. In 15 years, among 15 years, 11 years had negative inflation rate. And growth rate was low, and more importantly, unemployment rate was close to 5%, which is quite high in the Japanese context. So after I became governor in March 2013, the Bank of Japan substantially expanded QE in terms of asset purchase volume and content, longer maturity bonds. The policy instruments changed from the interest rate to the growth of the monetary base. The policy change was to achieve the 2% inflation target, which was introduced in January 2013, before I became governor, so-called at the earliest possible time. Thus, the new policy was named Quantitative and Qualitative Monetary Easing, or QQE. The initial reaction from the economy was quite significant. Growth recovered and the stock market rebounded, while the consumer price inflation rate reached 1.4% by spring of 2014. However, the increase of the consumption tax rate from 5% to 8% in April 2014 and still rather stagnant wage increase made personal consumption deteriorate with the inflation rate declining. So, in October 2014, the Bank of Japan expanded QQE by substantially increasing the amount of JGB purchased, for instance, from around 50 trillion yen to 80 trillion yen per year, with longer maturities, from remaining maturities of around 7 years to 7 to 10 years, and committing to a higher increase of base money for the coming years. Now, oil prices, which had been around $100 per barrel, started to decline toward $50 per barrel in 2015 and reached less than $30 per barrel in early 2016, reducing inflation rate in Japan to almost zero. The situation required the bank to further strengthen monetary easing significantly. By the way, even in that situation, unemployment rate continued to decline from close to 5% to the middle of 3%. Negative interest rate policy actually started in Japan in January 2016 by imposing negative 0.1% interest rate on incremental part of the 3 tiers of excess reserves at the Bank of Japan. And also, the bank lengthened the remaining maturity of JGBs, holding up to 12 years. The bank certainly learned from the experience the ECB and the other European central banks had utilizing negative interest rate policies so as not to undermine financial intermediation by the banking sector. Considering unstable international financial markets and weakening emerging markets economies, in July 2016, the Bank of Japan decided to expand again QQE by increasing the purchase of ETFs and announced plans to make a comprehensive examination of the QQE with negative interest rate policy. Then, in September 2016, after a so-called comprehensive examination, the bank introduced yield curve control, or YCC, accompanied by new forward guidance to continue increasing the monetary base until the 2% inflation target is achieved, and with widening operational tools. The inflation rate recovered toward 1%, although because of the consumption tax increase from 8% to 10% in October 2019, inflation rate slowed down slightly, but still in the positive range, and growth rate continued to be around 1% or 1% plus. And more importantly, unemployment rate continued to decline toward 2.5%, which is roughly half of the close to 5% unemployment rate during the 15-year-long deflation. Then in early 2020, the world economy was seriously affected by the COVID-19 pandemic, which reduced supply as well as demand, causing it to become mired in negative growth and deflation. Japan was no exception. By 2022, the pandemic became less severe and the world economy started to recover. But then the war in Ukraine erupted in February 2022, which significantly raised energy and food prices, resulting in extremely high inflation, the highest globally in the last 20 years. Again, Japan was no exception. Inflation rate rose from around 1% to 2%, and then it reached actually 4.2% January this year. But again, unemployment rate continued to be around 2.5%, so that the labor market continued to be fairly tight. Japan's current inflation is almost solely caused by higher import prices. In its January outlook document, the Bank of Japan expected that the CPI inflation rate would slow down to less than 2% by the middle of fiscal 2023. So the bank decided to continue YCC. At the same time, the bank expected the inflation rate would thereafter rebound from the second half of fiscal 2023 in the case of continued economic recovery and strong wage increase. Actually, this year, wage increase reached slightly more than 3%, highest in the last 30 years. So if these positive factors continue in fiscal 2024, the 2% inflation target might be achieved in a sustainable and stable manner, accompanied by the wage increase. This is because, first, firms and workers are now discussing wage increase to compensate for inflation. Therefore, the no inflation, no wage increase norm, or long-term inflation expectations anchored at near zero, created during the 1998-2012 deflation, will finally be broken. And two, employment increased by more than 3 million in 2013 to 22, mainly through the higher labor participation of women. But the working age labor participation rate of women in 2020 was more than 70%, increased by about 10% compared with 2012. And this more than 70% female participation ratio is higher than in Italy, the UK, US, France, and Canada, and almost comparable to the UK and Germany. Therefore, no substantial increase in the labor supply can be expected, so wages must rise. Once the 2% inflation target is accompanied by a sufficient wage increase in a sustainable manner, the Bank of Japan may be able to gradually dismantle unconventional monetary policies such as YCC or negative interest rate, as well as QQE. Then, we can say that unconventional monetary policies were effective, after all, in eradicating persistent deflation and anchoring price stability at around 2% inflation. Admittedly, it took many more years than anticipated to achieve this objective. Now, come to the United States. The US economy deteriorated since the global financial crisis started in September 2008, and the FOMC reduced the federal fund rate to 0 to 0.25% range in December 2008, but decided not to go to the negative range in view of practical and legal considerations. Instead, the FOMC employed a balance sheet policy, or BSP, with forward guidance. BSP was basically QE through large-scale purchasing of long-term treasury bonds and mortgage-backed securities. As QE was originally started by the Bank of Japan many years ago, and the word quantitative easing was invented by the Bank of Japan, the Federal Reserve surely knew it quite well. QE1, November 28 to June 2010. QE2, November 2010 to June 2011. And QE3, September 2012 to October 2014, had worked quite well to overcome financial stress and economic downturn in the United States. Although the FOMC discontinued QEs and raised the federal fund rate to 1 to 1.25% range in December 2015, this did not significantly reduce its enlarged balance sheet. Then the pandemic erupted in early 2020, and the FOMC reduced the federal fund rate again to 0 to 0.25% in March 2020. The FOMC restarted tapering in November 2021. Now, the situation radically changed when inflation accelerated in 2020. The inflation rate rose sharply from below 2% in the spring of 2021 to above 8% in 2022. In response, the FOMC raised the federal fund rate from 0 to 0.25% range to 4.75 to 5% range by March 2023. On the other hand, the reduction of the enlarged balance sheet continued to be quite gradual in view of its impact on the Treasury and MBS markets. Anyway, the role of QE, as well as a period of interest rates below or being low or low for long, has ended, and conventional monetary policies have come back to the United States. Now, going to the European Investment Bank, European Central Bank, after the GFC and particularly after the European debt crisis, the Eurozone economy deteriorated significantly, and then the ECB opted for negative interest rate policy rather than QE by reducing its deposit facility rate from 0% to minus 0.1% in June 2014, partly because the Central Bank of Denmark had already been implementing negative interest rate policy since July 2012, and QE in the 19-country Eurozone could be quite complicated. Although monetary policy is unified under common currency, government bonds are issued by individual countries with different interest rates. So since then, the ECB reduced the policy rate from more times to reach minus 0.5% by September 2019. Apparently, negative interest rate policy reduced the benchmark overnight rate and propagated along the whole yield curve, which stimulated the economy. At the same time, a significant side effect for the banking sector was reported, so that the ECB introduced the two-tier system under which a significant amount of excess reserves were exempted from the negative interest rate. The European Central Bank had recognized the constraint by the effective lower bound, namely how deep the negative interest rate can be lowered, so that it launched the Asset Purchase Program, or APP, which is QE, in January 2015. Subsequently, QE was expanded by increasing the list of national agencies whose securities were eligible, changing the issue limit, and adding regional and local government bonds to eligible securities. Since the Eurozone covered 19 countries, now of course 20 countries, the ECB is prohibited from monetary finance of those governments. Implementation of its QE was much more complicated than QEs by the Bank of Japan and the Federal Reserve. However, certainly, its QE coupled with negative interest rate policy was effective in overcoming financial stress and stimulating the economy in the Eurozone. Then, like the United States, the Eurozone was affected by the pandemic since 2020 and seriously shocked by the war in Ukraine since 2022. Faced with close to 10% inflation, the ECB started to tighten its monetary policy. First, it raised the deposit facility rate from 0% to 0.75% in September 2022, and subsequently increased the rate 5 more times, once 0.75%, 4 times 0.5% to 3.5%. Second, it started quantitative tightening, or QT, in March 2023 at a measured pace. As in the United States, unconventional monetary policies have almost ended their role, and conventional monetary policy has come back to the Eurozone. I have reviewed the unconventional monetary policies of the Bank of Japan, the US Federal Reserve, and ECB. In the category of unconventional monetary policy, several different truths are available. Large-scale asset purchase is common to all three central banks, but the assets chosen differ from one central bank to another. The BOJ mostly bought long-term government bonds, along with much smaller amount of equities, commercial paper, and REITs. The Federal Reserve mostly bought long-term government bonds and mortgage-backed securities. The ECB was the most hesitant in purchasing government bonds, as bonds are issued by national governments. The ECB and the Bank of Japan adopted the negative interest rate policy, but ECB went deeper. The Federal Reserve did not adopt the negative interest rate policy. Only the Bank of Japan adopted yield curve control, although both the Federal Reserve and ECB do see the benefits of lower long-term interest rates to stimulate the economy. All three central banks tried forward guidance, but its effect on inflation expectations was unclear. The Federal Reserve and ECB made an exit in 2021-2022 as they started to raise the policy rate and stopped large asset purchase while maintaining large balance sheet when the interest rate rose sharply. The inflation rate in Japan is high for the Japanese standard, but much lower than in the US and Europe. Since imported inflation in Japan is supposed to subside toward the end of this year, during my tenure, the Bank of Japan did not make an exit. Although we have to wait for rigorous academic analysis to determine the effectiveness of each policy tool of the three central banks, we can say that unconventional monetary policy contributed in each country and region to faster recovery from negative shocks like the global financial crisis and the COVID recession, and contributed to avoiding deflation. All in all, I must say that unconventional monetary policies are unconventional compared with conventional monetary policies, which had been practiced by many central banks in the last 200 to 300 years. But unconventional monetary policies are quite new. Even in Japan, it started only 2001. So most central banks have only experience of non-conventional, unconventional monetary policies for 10 to 20 years, compared with almost 200 or 300 years of practice of conventional monetary policies. But I hope all of you would be interested in unconventional monetary policies and the effectiveness of the unconventional monetary policies compared with conventional monetary policies, because unconventional monetary policies, US and the European or Eurozone have already started to exit, but in the future, unconventional monetary policies might come back when economies are faced with serious shocks and low inflation and low interest rate. Thank you.
Thank you very much, Governor Kuroda. And it was really thought-provoking speech and putting all the hallmarks on academics to analyze unconventional monetary policy. And we'll move to now moving to a Q&A session, but with my dictatorial power that I'd like to ask a few questions myself first. And yes, you mentioned all the details of the inflation rate and unemployment rate, employment, and all the good things about real side of the economy. And all in all, so in this 10 years, the first 9.5 years, inflation rate was below 2. And the last 6 months or so, that the inflation rate became above 2%. So I want to separate into 9.5 years and half year. And the first 9.5 years, it was below 2%. And there are some critics saying that, inflation targeting was a failure. And how would you you had some hints in your speech, but how would you counter to that argument, inflation targeting didn't work or it was a failure?
Quick answer is that inflation targeting has worked, but certainly 2% target has not been met for, as you said, for 9.5 years. Why it took so many years before 2% target is met? Maybe one important factor, kind of unique factor existing in Japan. As I said, the Japanese economy had been mired with mild but persistent deflation for 15 years. And that 15 years time, not only prices continue to decline, but also wages continue to decline, and economic activities continue to be suboptimal, and unemployment rate fluctuated around 4 to 5%. Probably during this period, kind of mindset of no price increase, no wage increase had been implanted among Japanese people, including companies as well as trade unions. And this mindset or norm had been rather difficult to change, despite, as I said, greatly improved economic conditions. By the way, for instance, corporate profit or corporate income almost doubled, and Nikkei stock index almost tripled compared with the deflationary period. But wage increase continued to be less than 1%, and inflation rate only around 1%, never reaching 2% inflation target. So I do think this strong deflationary mindset was so difficult to eradicate. But now I think that norm or deflationary mindset is disappearing.
Okay, so I think paraphrasing that, it was awfully difficult to break this zero inflation expectation, zero wage increase, and zero inflation. That this zero equilibrium is awfully difficult to break. And meanwhile, you cited this expansion of employment, increase in economic activities, and labor shortage just before the COVID, and growth was high. So real side of the economy was doing really great. And I think politicians didn't criticize you for not achieving 2% because the real side is doing really great. So in this, in academic literature, we call it flexible inflation targeting, that it's not just inflation rate, but you should evaluate the real side. And if we go stretch that to a U.S. context, the U.S. has a dual mandate of price stability and maximum employment. And but the ECB is more single mandate price stability. So would it be fair to say that Bank of Japan is a single and half mandate, because the Bank of Japan Article 2, Bank of Japan Law Article 2 says that Bank of Japan conducts currency and monetary control aiming at achieving price stability, thereby contributing to the sound development of the national economy. You achieved the sound development of the national economy for sure, while the inflation rate was below 2%. So would you agree to my hypothesis that a single and a half mandate and you achieved it? You're proud of it?
It's somewhat difficult to answer to a very interesting argument. Of course, as you said, the Bank of Japan article itself, Article 2 says that the Bank of Japan conducts currency and monetary control aiming at achieving price stability, thereby contributing to the sound development of the national economy. But I think that the main objective is price stability, and in that sense, like ECB and other central banks in the world, Bank of Japan is a single mandate central bank rather than dual mandate central bank like Federal Reserve. But on the other hand, as you said, the Bank of Japan law itself mentions the sound development of the economy. And in that sense, Bank of Japan does not pursue inflation target, whatever economic situation is made. That is not the case. In that sense, I agree what you said, but I may not be able to agree to the expression you mentioned, 1.5 mandate.
Okay, thank you. So we go to the last 6 months. So those critics who criticized, you didn't achieve 2%, it was failure, flipped their argument, and now they're criticizing that, it's above 2%, you overachieved 2% target, why don't you tighten? You achieved 2% target, and why don't you tighten, and that will prevent yen depreciation and other things. And so what is your argument that I think you hinted in the speech, but how would you characterize what the last 6 months situation is?
As I said before, the current inflation rate, 3 to 4% inflation rate, this inflation is almost wholly caused by import price hike. And already import prices have started to decline. And so, as I said, consumer price inflation reached 4.2% in January, but declined to 3.1% in February. And this downward trend will continue for some time to making inflation rate less than 2% by the middle of fiscal 2023, the current fiscal year. So the Bank of Japan, after a lot of discussions at the Monetary Policy Board, decided to continue the current extremely easy or accommodative monetary conditions until the 2% inflation target is achieved, met in sustainable and stable manner. And as I suggested it may take a few more years before we can be assured that the 2% inflation target is met in a sustainable and stable manner based on stable wage increase. And so simple answer is the current inflation is almost wholly caused by import price hike, and import prices have already started to decline and continue to decline for some time, so that inflation rate would go down below 2%. So it's not appropriate to tighten monetary policy or normalize monetary policy at this juncture.
Thank you. Yeah. So January Outlook document says that board members projects that fiscal 2023 inflation rate projection is 1.6%. So that is basis for the judgment that super easing should continue, at least for the time being. And I think that's a very clear implementation of this inflation targeting that we academics has proposed. So thank you very much. Thank you very much for answering wide-ranging questions, not only unconventional monetary policy, but the Japanese economy in general.
Yeah.
And if I summarize in one sentence, I think your prediction of labor shortage and wage increase coming this year and hopefully next year will make the inflation rate at 2% in a sustainable and stable manner, and you'll come back here in a year and declare the inflation target is achieved. It's a happy end story. We would like to hear in a year or two. Okay, thank you very much.
Thank you. Thank you very much. Thank you.